then once you find that trading system that proves to be the most reliable, you've got to stick with it, understanding that those computer systems and everybody that controls the world is not going to let it be seeming to be most reliable every time. So the important thing with trading is not jumping from chart to chart to chart to chart to chart like most people do. It is to stick with charts, trading systematically, consistently, based on things that you find to work. Now, we're going to start out talking about the most simple of Fibonacci tools, Fibonacci Retracements. If you're using Thinkorswim, you could actually go to drawings, right here, Fibonacci Retracement. Now, the thing to look at for Apple, which is kind of funny, and no, I didn't buy any when it came down to that level I'm getting ready to talk about. I'll be the first to say that I did not do that, even though I think it was 4 or 5 weeks or 3 or 4 weeks before it actually hit that we put the line on our chart. But you know, one thing before I get started with it that I want to say is, many times you'll hear me talk about using the closing prices, and there's a really good reason for why I do that. You have to think, how long every day is the stock market open? There's an easy question. How long every day is the stock market open? Six and a half hours. Does that sound about right? From 9:30 a.m. Now you're being difficult, Scott. Anyway, 6.5 hours. How many hours are there in a day? 24. So the reason I like to stick to closing prices is because for what, 17.5 hours a day, it's the closing price that seems to be what's going across the TV screen, right? Plus, there's a lot that can happen in the day that actually results in having no meaning whatsoever. That's one sad reality too. Now, when you use Fibonacci retracements, there's, I like to start, if I'm trying to measure for a pullback on a chart that is seemingly a good Fibonacci retracement chart, you don't need to play the red candle, green candle game. Right now I'm just showing a weekly chart. And on the weekly chart, what I'd be looking for instance, this is clear back where I'm starting this at, is in March of 2009. This was when Apple was like, I think it was something around like 150 bucks. And it ran clear up here in September of 2012 to a price of $700. They've done a split since, obviously. Now, when I'm looking for an opportunity over time, it's not necessarily for this opportunity. This actually is not the time I'm talking about, where it made this double bottom after that fall from 700 to 350 and then made that double bottom and went up. That's not necessarily the time I'm talking about. We actually had a time where, when measuring a prior move that it had made, we could again, and I'm going to take this down just a little bit so we can see it better. We could again use that lowest close to the highest close. And this is that area I said, like 3 or 4 weeks before we actually saw that happen, we talked about it, and sure enough, it kind of hit it. So, if I'm looking for a longer term investment and I see repetition in the chart pattern. The time to necessarily buy a long-term investment isn't when, it's sitting up here and, makes a, that's the time to trade it. But if we're using the weekly chart and we find consistency based on prior moves, and we see that opportunity, we actually got to put ourselves in a situation where we become willing to buy it. Now, in this particular case, it actually didn't stay down there very long. On August 24th, it gapped down there, and then it skyrocketed. I mean, in the first hour, it was not all the way back up, but you can see by the end of that week, it was back up above where it had closed the prior week. And does anybody remember what was happening during that time with options prices? I mean, if you actually sit back and remember, I had actually bought $100 calls on that Monday. I played way too much, but I saw it rise, from like 92 up to like 96. And I said I was paying too high a premium, but I'm going to take a shot on it. That thing ran like a wild man after that, and I still didn't even double my money. It was kind of crazy because the premiums were ridiculous, but even as it went up, the premiums were reducing at a rate actually faster than the delta. But a long-term investment trade, is that necessarily an options trade? I actually say all the time that you can't isolate yourself to like just being a day trader or just being a swing trader or just being a long-term investor. That's, the markets tell you to do different things at different times. Well, sometimes they also tell you not to be an options trader and to be a stock trader. Did I buy down here? No, I didn't. If I would have bought here, what would I have done? Well, exactly what I told you last Friday. I'd have sold $120 puts or covered calls, and I'd have waited till the earnings. Did I do that? No, because I didn't have the comments. But as you can see, on these long-term runs, like we had before, if we were looking for a continuation in that pattern of trading, we may actually right now be thinking that what may we be thinking right now about Apple in relation to a bottom? And you're right, Leonard. There was like 10 minutes to make a decision, if that, maybe closer to 5. But we would actually be kind of thinking, to answer the question I asked, that the bottom might be in. Now, I'm one that says over and over again, for your longer term investments, rather than trying to call the bottom, to wait for the first higher low and higher high sequence. Because if it truly is the bottom, you're going to have a long way back to the top. Now, if indeed this was the bottom and we had an up move and a down move, would this low have been higher than the prior low? And the answer there is yes, it would have. But the other thing, and Ryan kind of pointed it out there, not really relative to the Fibonacci's in general, but the last time it did this, the last time we had this same thing, yes, it did make that double bottom, so might there be another opportunity? Well, it's hard to tell the future. But if we go back and put this particular set on here, and again, whether you're using a weekly chart or a 5-minute chart, if you're trading with Fibonacci's, I've just found a lot more consistency using the closing value of whatever candles you're doing. But here's the thing I wanted to point out. This double bottom, while yes, was a really pretty opportunity to buy, even if it was like on the W break, the important thing is to see how it traded in relation to those Fibonacci points. You see how it came down, it rested right on the 50% line? It went back up to the 38.2 line and pulled back again. There is a big difference in that back here and what we've seen here. In fact, this brings up another really good point. If you're looking at closing prices and closing prices alone, couldn't it actually be this chart that you're viewing that by? In which case that 50% line has not happened yet. Does everybody know what kind of chart I'm on right now? And the other one was a candle chart. What is this chart here? This is a mountain chart. No different really than a line chart other than the fact that it's filled in. See, there's your line chart. And I guess Thinkorswim calls it an area chart. But when we look here, right now is actually a lot different than back here, isn't it? See, back here we had a close on the 50% line and then a higher low. That low here was higher before the up move was made. So if we are comparing those points using the closing values, sometimes even when trying to tell the difference in long-term investment and not long-term investment, we get a little misconstrued, because while yes, this price did happen, yes, you could have bought shares at this price, any one of us could have. No, I don't think that was long-term investment time. Yes, I think that would have been one heck of a trade. Be hard to disagree with that, right? But if we can, and you know, now that we've had the earnings, we're going to be given the opportunity to see how it trades in relation to these Fibonacci retracements. And if we're looking at this, what three things might we want to see if we plan for a long-term investment in Apple? There would be three things on this chart that we would look for a long-term investment. Something that we could buy and then trade in relation to our stop. And what I mean by that is, you know, from the time we buy, you got to watch that low you bought off of. That kind of becomes your stop, because if it doesn't hold that, then no, that wasn't the bottom. Well, that first thing would be if we could get, you know, a weekly close down here around that 94.59 value, right? What would the second thing be? And remember, kind of think back here where I said it was at the 50% line, went to the 38.2, came back to that 50% line, ended up making on the chart what was a W break. Well, if there was a 38.2 line right across this high, then what did this low right here do? It retested that support of the 38.2 line, right? Fibonacci retracements is a linear trading system. It's a two-point trading system. It's linear, and it produces a series of fixed value lines for you to use as what? Essentially, any line we put on our chart could also be called one of two words, right? What would those two words be? Support or resistance, right? That's what these lines are. Well, seeing how before the up move off of the 50% line that broke the 38.2 line also retested that, would we want to look and try to like go long right at the 38.2 line, or what specifically with the 38.2 line would we want to see? There you go. You'd want to see it hit the support and make a positive move from it, right? Now, what kind of positive move? That can be an interesting question. Is it a couple pennies? No. Is it $5? Absolutely not. But, you know, if you see a large number on the bid side of your level 2 at that level and you begin to see an up move, and generally what you would see in that case is you'd see a few times, at least during a single day, that you hit off that same point. And if you keep hitting it, not falling below it, and then you hit it again and don't fall below it, and then you hit it again and don't fall below it, you'll almost always see on your 15 or 60-minute chart a bit of a consolidation pattern. But using something like on your short-term chart, and I wouldn't use anything less than a 15-minute chart, but you know, on your 15 or your 60-minute chart, something like a consolidation range break or a W pattern would be a fairly decent confirmation of some bullishness once the support's held. What would the third point be that we would look at? So we've already discussed hitting the 50% line and making a positive move, hitting the 38.2 line and making a positive move. What would the final point be that we would look at a long-term investment entry? Remember, if we're looking at that weekly chart, we're not looking at a day trade. There you go. A break of the 0 line, at which time the 0 line would become what? It'd become support. But the funny thing about that is if you're really, really firm on that, it'll probably wiggle around just enough if you're disciplined on your support level to make you sell it. And then kind of begin to upset you. You know, in essence, if you're playing what you think to be the bottom, wouldn't you then have to begin another set of Fibonacci's that you keep moving up each and every week that gives you a higher close? At which time, what would become your stop? What would become your stop in that case? The 50% line. And why would it be the 50% line on a chart like this? Remember, this isn't something I'm saying you just throw onto any random chart. There's a lot of charts that it'll have zero relevance to whatsoever. But a chart that it does hold relevance to, why would it have been that 50% line? And I'll kind of edit it to make it so you can see more of what I'm talking about. The reason it would be this is really simple. Well, actually, let me start by saying this. How you would determine what line it would be is you'd go through the last up move. If you would have bought, did you ever close below the 50% line here on this up move? Or did you simply retrace to it? And if I continued it further, Did I ever drop below my 50% line? And if for some reason I would have called this bottom, or even I would have to say that the better trade would have been either the W break or the W retest, this would have been luck. This would have been, hey, I got a good trade. But if you go all the way up through here, you'll find that if you would have kept continuing your stop would have made you profit, right? Especially on August 24th when Kramer told everybody to sell everything, and all Apple had done was the 50% retracement. So regardless of what exact penny price you bought, if you were making the investment under the assumption that it was going to replicate that style move, trading according to your stop would be also trading in relation to what made you buy it to begin with. And as any candle kept going up, if you ended up with a candle close at 140, well, 122.78. Well, right now we're talking about Fibonacci's, and yes, to answer your question really quick, that I would say was a W break. And if you wait until after we do a little bit of Fibonacci discussion, it's also a head and shoulders. See, left shoulder here, right shoulder here, head up here, and it's the second time it's done the head and shoulders on the weekly. So the other thing to look at in conjunction with this is, quite frankly, why would somebody have wanted to buy here, held through this big up move, and let it drop that far? Any reason somebody would have wanted to do that? Well, even if you don't watch it, you wake up one day and the news is talking about a 1,000-point gap down on the Dow. I'm pretty sure if you own any stocks, you're going to look, right? And then you see Apple gapping down $20 from the Friday's close. Get a little scary, right? Now, if you're making those long-term investments, there's also other things that you could use in conjunction with that point where the common shares might not be in your best interest of being invested in, but still using that same tool. One of those things is to not just mark the overall run, but mark each individual run that's found within it. In which case you could have got out a lot better here, even if you waited for the weekly close at 115.52, than you could have down here, right? As a matter of fact, if you'd have waited and sold your shares that you had bought down here when it failed that 119.27, but the close of the week was 115.52, chances are you probably would have been ready to buy it again down here, right? Because naturally, people that trade stocks like to, as soon as they sell something, wonder when they should buy that same thing back again, right? You guys ever done that? Oh, we just sold this. When do I buy it back again? So, that would have been okay. Now, the next thing to kind of look at as far as Fibonacci's go, and I'm using Apple because, quite frankly, Apple's a phenomenal Fibonacci chart, both for retracements, which I would trade solely using retracements, basically establishing your support and resistance, and making what two assumptions? Let's think about that. What two assumptions do we make? Support will hold, and resistance won't be broken. And when we had those Fibonacci retracements up there, we already talked about what each of those lines were. What did those lines signify? There's only two right answers: support or resistance, right? A line above our price is resistance. A line below is support. Meaning, if we bought down here and we hit here and pulled back at all, we would sell. But now, we could have had another buy, or even if we were late to the party, using our Fibonacci retracements, you could have bought even when it crossed $104, right? Targeting up here, but also having support. And when we say support, if you're talking about a long trade, support is also equal to what point of any trade that you're in. Support also equals the stop, right? Support slash stop. And when we say stop, we mean the point where you got to sell and say, well, I guess that one didn't work out like I thought. In this particular case, where we're sitting right now, if you're trading using the Fibonacci retracements, maybe not so much with today's close, but if you looked at Friday's close, what could you have seen about that going into earnings? In relation to only support and resistance, where was Friday's close? Right in the middle of it, right? I don't even have to try very hard, and I'd probably be pretty darn close on guessing that, right? We're right in the middle. Right in the middle between the 38.2 line and the 0 line. So let's think about that. If I was long, which I was not, and the close of this candle before the earnings was about halfway between support and resistance, wouldn't I also have to maybe think that earnings could probably be a catalyst for something? I mean, there's times where stocks go completely crazy for earnings, but if there was going to be a change in direction whatsoever, more than likely earnings would, there'd be a better chance of earnings causing that than anything else. Wouldn't you agree? What didn't happen this time? Kind of lost on your statement there, Flyer. Did it break above 120 or fall below 110? If so, it hasn't done anything. In reality, if you actually look at it, right now to make a lower low or something, it'd have to go below 110, and to make a higher high, it would have probably hit about 120. So in reality, for what we're talking about, it earnings didn't do crap. So if you were long leading into the earnings, understanding earnings could be a catalyst for a move in either direction. What would have been your best bet when you saw that opportunity on Friday? Let's say you were long in common shares. We won't even get into covered calls, but you know, protecting with puts, almost entering like a strangle trade, right? if premiums weren't inflated before the earnings, Friday would have been the perfect time to enter a strangle trade, wouldn't it? Wow, it could go up just as much as it could go down. Now, while these lines, and I'm keeping it simple, these are just lines that serve as support and resistance. Why these lines that we've talked about here so far would guide you through a long trade, would you want to use them for your short trades? Would you want to use these same lines for your shorts as you would for your longs? No. So here's what I'm going to do. I'm actually going to change the color on these. I'm just going to change them to green really quick. They're all going to be green. Why would they be green? Well, that tells me I'm talking about a long trade, right? And on a short trade, well, let's say if on a long trade I went from my lowest close to my highest close, for my short trade, how might I want to draw my Fibonacci retracements? From my highest close to my lowest close? In which case, what did I see with Friday's weekly candle close? There we go, Moss. So you hear us talk about 50% a lot. And, you know, if you don't know what we're referring to, there's a little, you know, if you ever took a science class, you probably were told the difference between scientific law and a hypothesis. Scientific law is something that always happens in science. In trading, there's some theories, I guess you'd say, where this little rule called the 50% rule, little definition of it is any stock that doesn't retrace more than half of its move is showing strength in the direction of that move. We saw the stock go up, this great big up move, and it fell right down to the halfway mark and started going up. For that long-term move, wouldn't we have to say that's showing strength in the up direction? And then later it did. I mean, obviously it showed strength in the up direction. It ran up like, what is that, 25 bucks? But as it went up, it said, hold on a second. I'm not showing weakness yet in the downwards direction. Do you guys see why I would say that? So now we're left at an interesting point, and I colored these red. Why would I color this set red when I have that green set there? There you go. Those could be the lines that dictated your short trade, right? Now, how would you use those lines at this point? That's the question. No, I would never use day trades looking at a weekly chart. I think that's like as good of an idea as laying in an interstate at midnight hoping not to get hit by a car. Simply put, from this point, let's assume you're not in a trade at all. Does anybody recall what Apple's last trade price was? I shut down my E-Trade Pro platform that had like the after hours trades on it. I believe it was like 115.29. But that's fairly close to this 116.01, right? And what did Apple options have on them today that they will not have on them tomorrow? What did Apple options have today that they will not have tomorrow? Well, they always have premium, but inflated premiums, right? So what could we look at with that while still using both sets of Fibonacci retracements? At which point, let me ask this first, at which point would we want to delete our red set of Fibonacci retracements? I just pointed at it. There's your hint. There we go. Close above the 50% line, right? And at which point would we want to delete our green set? Okay, so first we can start out, because I like to have my chart as clean as possible with only the relevant material on it. So I could clean up my chart by like getting rid of that 61.8 line, right? And here I could get rid of it like that. Why would I get rid of those two lines? Why would I do that? There you go. If I'm not going to make a trade off of them, I don't need them on my chart, right? So why would I leave this 100% line down here? Or the 100% red line up here? Why would I leave those there? No, the actual reason for me is so I can see where my line starts and finishes. Sometimes, and I've made this mistake, I delete too many lines and then I'm trying to figure out where those lines came from. In which case, it is not difficult at all to turn those 100% lines to a dash line. Why would I be turning them to a dash line? What do I turn other stuff for a dash line? To remind me not to trade it, right? I either already traded it or I don't want to trade it. It might be relevant on the chart, but I'm not going to make a trade on it. At least not a trade based on this particular system. Now, getting back to that other question, if I've been waiting for Apple to have its earnings, and it simply has not yet, and then all of a sudden it has its earnings, and it's like, man, okay, I wish I would have like gone short when it was up here at 119 something, but I would have been paying such high premiums, it would be like it being at 113, 114. So did I really miss anything? No. What could very easily here be my approach to trading? To help you out, let me first ask you when Apple's next earnings might be, even if I don't see it on my chart. Today's October 27th. When can I assume the next earnings is? 3 months from now, right? It's not penny stocks where they report earnings anytime they feel like it. They're on a strict schedule. What's going to happen to options that expire after the next earnings, even if I'm looking at them right now? Getting right back to that premium inflation, right? So if I'm looking at planning a trade, now that the earnings has happened, why not plan one that encompasses as much of the period as possible up until the next earnings? Wouldn't the January monthly like expire a week, week and a half before their next earnings? Isn't that probably, I mean, think about it. The monthlies always expire the week that financial stocks report earnings. That was 2 weeks ago. So there's been like a week and 2 trading days since that week, since the monthlies expired. A pretty good chance that I'm going to be able to catch and even build on a swing based on that expiration into the next earnings without having to pay that inflated premium. Let me ask you this, and we will have to wait until tomorrow to actually be able to see where the premium price of the options is now that the inflation won't be there. But let's think of something. Even based off the closing price today, 114.55. If Apple dropped down to that 38.2 line at 103.81, that would be, I'm just going to use redneck math, a $10 move. What percentage gain do you think I would see on Apple puts, even trading 3 months out, if it moved $10? Let's think about it. There is one thing I could do to actually look at that. If you pull up on an options chain and look at your deltas, your delta is probably going to be the same or close to the same tomorrow as it is today. This is why I say even when you have that inflated premiums, like today, if we would have traded Apple, the 114 puts I pointed out, they were at 262 was their low a day. It fell over $2. It was like $2.85, and they went up $1. The sad thing is normally, if it wasn't an inflated due to earnings situation, you'd have paid 65 cents, maybe 70 cents at the exact same time for those, and you still would have made only $1. The deltas don't change, or don't change much. So if we looked at, say, a 105 put for, actually, I gotta change something on here to be able to see a 105 put. If I went to my options chain and looked at a 105 put for January, don't pay attention to the fact that it's 285 by 325 right now. Look at that delta at 0.26. And if I'm looking at it right now and I say, well, you know, if we opened up at the same price we closed at today, is that a likely scenario? Yes. But is it possible it gaps up a little bit? Yeah. Regardless, even from this price at 114.55, and on the short trade down to my 0 line, wouldn't that be my next support level? And I'm going to assume support will hold. So minus 105.76, $8.79. Now, you know, you're going to have a little bit of theta and stuff in there, but if you're trading 2.5, 3 months out, is that theta really going to have a noticeable effect? What do you think? It won't be very noticeable. You know, it might be noticeable week to week, but it's not going to be like day to day or hour to hour. But if I multiply this just simply by that delta at 0.26, I'm looking at a $2 and I'll say 28-cent move. I like to round down when budgeting. Should I hit that 105.76? Now, at this time, all I can see is where those options closed at today, 285 by 325. But those had some earnings premium inflation on them, just like all the other expirations did. Where would it be lucrative to me as a starting point to see if this trade's even going to be worth it to make? What would I not want to exceed paying for that option tomorrow morning? If I'm looking at a profit at my zero line of 228, I wouldn't want to pay more than 228 for them. And there's a reason for that. You know, the most dangerous time in any trade is the time when you first start building the position, that first buy. Many times it looks one way and turns around the other way real quick. But plain and simply stating, yes, Moss, but that's irrelevant to what I'm talking about right now. Anyway, simply stating for what we're getting at here, the fact that I have two different sets of Fibonacci's on here, a green set and a red set, a long set and a short set, tells you that I may have to be willing to make what type of trade. A strangle or straddle trade. There you go. At what point might I want to look at a calls entry? I'll say from this chart you can see right now, 3 different points that would be appealing. If I took this short trade, like if we were, hell, if we opened up tomorrow at 116.01 and started falling, that'd be a pretty clear-cut puts entry, right? At what one of 3 points would I want to look at as a calls entry? Or as that strangle entry, we'll say. What do you think those 3 points would be? You know, one of them would be, to me, the blatant obvious. If it broke above that 50% line, right? If it broke above the 50% line, it's no longer showing strength in a down direction. But I might want to wait for a down move first to sell my puts on, especially if I'm trading like 3 months out. So there's one point. Where might another strangle point be? If I use this last low and use the exact same tool, and so you can see it better, I'll just leave that 50% line there. Maybe a positive move from 114.73. You could say, well, it closed below that today. Has the weekly candle closed yet? Remember, we are on a weekly chart. Has that weekly candle closed below that yet? No. Now, if you look at that, some people might say, well, you know, the strangle or straddle trade just sometimes to me seems like, well, I'm going to lose on one side, so I might as well wait till it breaks out in either direction. And I think that's a perfectly fine thing to say. But if you're trading one like Apple using the Fibonacci retracement tool, where would the point to buy be that would look better for puts or better for calls? Let's start with the better for puts. Maybe you don't want to, like if we're gapping up tomorrow, 115.30, maybe even get that 116, and we start to fall, and you're like, yeah, but I don't want to buy calls if it drops $1.25. Maybe waiting for it to fail, that 114.73. Couldn't that be, hey, I was willing to pay a little more for puts, but at least I didn't waste money paying the call side? Or at what time might the calls buy be your better buy? And you might say, oh, well, when it breaks that zero line, but I would actually argue that when it breaks the 116.01, the current resistance on the short trade, right? It breaks the 116.01, then I just broke resistance, which is to a short trade like failing support is to a long trade. And then I come up with an area that tells me I might want to wait for one of what two prices to break on Apple before making an entry. What do you think? Well, I mean, that would allow an incredible run to happen first, but do you see what I was meaning on if it were to go above the 116.01, then you could also look at it as, wow, it retraced 50% and moved up. So if I allow it to break the 116.01, it just eliminated one bearish argument, meaning it broke a resistance. And I would look at my next resistance being that 50% line, right? So between that value of 116.01 and 114.73, what would we essentially be creating? Most of the time, I'll put it on my chart as like a little gray box. And what does that little gray box mean when I put it on my chart? Yeah, no trade zone. You know, sometimes the strangle or straddle trade is the thing that I'll advocate the most. But sometimes being just a little bit more patient and maybe paying a little bit more for one side or the other is actually the best choice. Now, the cool thing, if you're using thinkorswim charts, you could take, and as hard as it might be, draw you a little rectangle right there for that box. Now you might say, I can't hardly see that. But if I'm looking at it, where did it go? Hold on a second. There we go. If I look at it like on an intraday chart, by already having my chart marked up, can't I actually see a reminder to myself that for my swing trade at least, I might want to wait on something to happen first? Isn't that something that anybody could probably easily follow along with? What do you think? Now, does this mean tomorrow I can't make any trades while it's in this box? Or does that mean for my trade on the January monthlies, I don't want to make an entry while it's in this box? What would you say in regards to that question? Because from 114.57 to 116.01, I still think that on a day trade we could make money. But that would be still a little bit irrelevant to what we're talking about so far with using the Fibonacci retracements. Extensions. Fibonacci extensions are a 3-point tool, okay? The Fibonacci retracements were a 2-point tool. Remember, you marked a low and a high or a high and a low. Fibonacci extensions are 3 points. You're either going to mark a high, a low, and a high to help you navigate through a down move, or you're going to mark a low, a high, and a low to help you navigate up through an up move. With that being said, it is not like, well, it had this high here and on this red candle, but then it came all the way back here and opened up. Yeah, you might find some accuracy on the shorter term, but you're really going to mess yourself up. It's not a red candle, green candle game. It's visible up and down moves, which means for marking your first point, you have to wait for what to happen. You know, if I was using those Fibonacci extensions down here, before I get this mark, I have to verify an up move made. Most likely going to be like on this candle. And yes, that's quite a ways through it. To be able to produce a target point of if it duplicates this move, and pay attention to how I say this, if it were to duplicate the move made from this low to this high, starting from this point, it would go to here. Well, if we started at that point, and that's really marking, if you missed the first move up on Apple, when it bottomed last time, when it did a little bit of retracement, we talked about points that it held. When it started moving up again, we've got a point to trade. Now, you'll see on mine that I defaulted my Fibonacci extensions to a 0 and a 100 line. There's actually a lot more. And I do use them on some charts. As a matter of fact, some of you guys might remember, I use a 78.2 for pullbacks on Apple. The reason is there's just been a lot of validity in that. Now, if I were to see this happen and I were to, let's see how far back it'll let me go here, and I want to walk you through in a specific way. Let's go back here. And let's just say that I'm looking at this point and I say, you know what? It went up, I missed that. It pulled back, it gapped up this morning. Man, if this thing were going to go up the same way it did before, this would be the Fibonacci extensions I have. Everybody with me so far? Okay. The 0 line, if I were to make an entry based on this, the 0 line becomes my what? What is the 0 line? It's the stop. If I were going to try to call the exact bottom and put a Fibonacci extension there, the 0 line is my stop. So I'm going to color that red. You know, if I'm in my long trade, I'm going to color that red because it becomes my stop. Now, you might find with some charts, like I said, there's other values here. I could put a whole ton of things in here. You may find with some things that each one of these gives trades if you're more concerned with making your broker money than you are yourself. You know, you might go up to the 23.6 line and come down, or go up to the 38.2, come down to the 23.6, go up to the 50, come down to the 38.2. You might do a whole bunch of wiggling. For the majority of the ones I trade, I find those to be a little bit irrelevant, so I don't even put them on there, except for specifically on charts that I find them to be relevant. But to mention them really quick, if you're going to trade in that aspect, then, for instance, this day where you gapped over your 38.2 line and started pulling back, that would be, well, it gapped above my resistance, but then it lost it, so you'd have to say almost a pullback from resistance, right? Which would have you selling your long. Now, if it bounced off this 23.6 line, that would be a positive move from support, right? So there's another buy. Here you come up to the 50% line, and it broke it. It broke the 74 or the 61.8 line, and then pulled back from it. That would be another stop point, and you'd wait to see if it bounced off a support. So on and so forth. You break resistance here, boom, you break the resistance. You could buy there, you crossed another resistance, and there you are at your target point. And what would you do at your target point? Sell. A few years back, I would use those and I would try to make all those buys and sells. And what I found out was on the stocks that I traded with that system, one of two things would happen. I'd either make it to my 100% line, or I would turn around at my 50% line on most of those stocks. Kind of odd, but that's what I found. And I also found that most of those times that I had that ingenious idea that if I sell it today because it's pulling back from that 38.2 line, I can buy it tomorrow if it moves up from the 23.6 line. And it was inevitable. Almost always something would happen and I'd never buy it back. And then I'd see this big move saying, man, I should have just stuck with the trade. So what I did was revamp things, and I was like, well, I'm not really comfortable doing it that way. If you're not comfortable, that means you're trading too large. So I reduced my position size, built a comfort with it, and then worked my position size back upwards. Very, very simple, yet difficult for many to think of like that. Now, in this case where we see, hey, maybe you didn't make this trade at all, but do you see some accuracy in the Fibonacci extensions in general? So far. I'm only going at so far. Well, let's see if it gives us another little bit of accuracy as we watch for a pullback to see, now that set number one looked pretty good, does it come down to set number two? And here you're going to say, well, hey, you went than that. Yeah. Yeah, you did. But what would you think is more important in trading? Exceeding your target or falling short of your target? What's more important? If you really think about it, if you were entering that trade this week or this week, you're wanting to see how many times you hit or exceed your target, right? Hitting or exceeding. Because clear back up here, if I take this back a couple candles to where I would say, if you're like, well, you know, we saw where I had that 100% line before, it's like, well, target hit. Now it's starting to look like it's definitely pulling back. Do I want to trade to 72.40? If the answer is yes, and I buy a trade for that, that means I was hoping to hit 72.40, right? Therefore, if it hits 72.40, I was right. Doesn't matter how low it goes, I was trading for that. And again, you know, you can stay, your zero line stays your stop, and oh, I got a little bit below it. Now, I like to call my Fibonacci targets PDC targets. Do you guys know what PDC stands for? Some of you do. I've said it a bunch, but a couple of you are new here, so you might not know. Yeah, pretty damn close. Well, I wouldn't say it's the cousin. I'd say it's the twin brother of PFC. And I'm not talking about private first class. But if I were to see this happen, and that was my target, yes, I might have sold my puts trade for that target, but what should I be thinking right away? What should I start thinking right away? If it goes back, yeah, it failed that, but if it goes back up above that, I might want to see if there's a long trade to be made. Well, you know what? It did that the very next week. Now, if I was using visible up and down moves, wouldn't you say that I'd want to use the ones that are being accurate to me? So this, from this low here to this high here, all one move, right? And from this low, well, now I'm looking at 88.78. I'm going to delete this line here because that was the one I either just traded for, or maybe I didn't trade for it at all. I just waited for it to pull back. I was looking for that point to make my buy. And sometimes when you first start trading a system, it's best to wait on the first one. Mark where you think it could go to, and if it does that, feel confident about the trade after it. Does that make sense? I want to make sure that makes sense real quick before I move on. If the points I used and the target it gave hit, don't necessarily trade that one. Say, man, I was right on that. Well, if I'm right on that, maybe I'll be right on my next guess of where it could go. Have a little confidence because you were just right, and make that trade and start your trading on it. So here, if I made this trade, well, it's going to jiggle around and do its thing and do its thing and do its thing. Wow. Would I care that it exceeded the target? So far, that I'm going to have to say really quick, that's irrelevant, Flyer. I'll get to that answer when I'm done through this. But whether it goes further above the target or not, think about this. When this thing's sitting at 74 bucks, 88.78 was an appealing target, wasn't it? When it's sitting clear down here, if you said, man, I think that could go to 88.78, I'm going to buy 85 calls. You're going to be happy at 88.78, aren't you? So whether it does this or even this is almost irrelevant, isn't it? But let me point something out. This is why if you're going to get a little overconfident and say, well, you know what, man, that thing hits my target and pulls back so often, maybe it goes a little bit above, but I'm going to try to call the highs on it. If I was going to try to call the highs, what type of trading would I want to do on that? You know, like I make the long trade, boom, I sell, kind of goes above it, but I'm trying to call the high.
maybe even right at my line, do I want to just go balls deep in a puts trade? Or do I want to scale into a trade, break my trade into sections? You know, take a little bit for the guess, take more when it's no longer a guess. Yeah, again, you know, I prefer most times scaling in thirds. See, now, as you get through this, yeah, it broke above the target here. And sometimes you might find that, man, it's starting to really confuse me why it hadn't failed my target. In fact, do you see this point right here? What it did? It opened, and then it came back down to what point? Before moving higher than the open of the candle. It actually came back to the old target. One could probably say here, support, right? It broke the resistance. Any line on my chart is either support or resistance. It broke resistance, it retested that as support and moved up. Is there a possibility that where I might have seen this as an up move from here to here to here, that I might have also missed this up move? Would you say that from this low here to this high was all one up move? And if so, why would you say that? I would say it because during the process, it did not make a lower low, nor did it make a low below a consolidation range. Here is all one down move that, yes, did make a low below a consolidation range. So is it possible from this point, when I see it open, retest my old target, and make an up move, that I have to say, is there another visible up move for me to trade for? The answer there, I would say, is yes. And again, hey, don't worry about the fact that it passed that target. That's just 3 times in a row so far that it's been right. And oh my gosh, would that be 4 times in a row? Would that there be 4 times in a row that it was right to the target point? I'm one that would probably have to say, yes, that's exactly what it's telling you. Now, without any confirmation of a down move, and as things go on and you're waiting, okay, let's back up a candle. Right here is a little different than we might have seen. It's like, wow, that's, you know, that moved from about $100 down to 94. That looks like a pretty good down move. You know, the first thing I want to do is mark these shorter down moves that aren't necessarily something I'd want to trade off of. And you see, like, wow, do you see how this just basically replicated that right there? Do you notice how sometimes I'll say, you know, from here it looks like it could pull back, but the trade won't get fun until it fails 94.04? Doesn't mean I won't take that chance, but I've got to watch that, because usually, whether it be Fibonacci's or whatever trading system I'm using, even though I see something that might be larger than that, I would actually see this down move here as having a few different points, and ironically, that matched up perfect with that one. But I would see a few different points, and I'm going to delete this long set, that it would have to break before the stock could crash. So I would be looking at that $94 area, and if we close the candle down below that, well, if we broke below it, it would become my stop, right, on a short trade. So on this trade, pierced below it, came back up above, I've probably got to think that I should get out of that trade. Well, what you end up finding out when you go through these is there's usually a cycle of multiple trades that you can produce. And what I mean by that I'm going to revisit and go back to the time that I had this set on here, okay? That was the first set we put on there. We saw that, hey, that kind of worked out. When it gets up to that point, you know, using that line, hey, it broke above it. Man, if it goes back below that line, I'm out. And again, going up through, what you're going to find is you have opportunities to make a lot of different trades. Now, let me ask you something. When do you think the options, the call options, were cheaper? The week it made this fall, or the week it gapped up and went back above that old target point right here? And the answer would, the call options would have been cheaper this week. So what I'm getting at with this, you know, if you made this trade up to here, okay, good trade. You're looking for the next trade you can make. Well, right away, you're looking at that last visible down move saying, hey, I think it can get to 72.66. At 72.66, you don't necessarily need to sell your puts right away, but you could very well do what? Buy your calls. Now you failed the 72.66. In relation to your puts position, what does that 72.66 become? There you go. Well, it became resistance, your stop out for your puts. So here, breaks above it. Well, I got calls and I'm out of puts. Now, what calls would you get once you can mark the bottom? It's, hey, something to be in the money by 88.78. Now, you also get other times where things might kind of screw with you. Kind of does this and then makes an up move and you're like, wow, that's a lower high, right? And man, that's starting to move down pretty good. You know, I'm going to buy puts and okay, I got a month of it trickling up, but it still didn't break that double top. It actually made another lower high. And then here, closed lower than these, so you're starting to justify to yourself all the reasons why you should be in this trade for this 76.09 target. And let me delete this one because we'd be out of this one. So you start to talk yourself into this, but then it moves up and visibly you can see it moves up past that last high close point. You know, right here it was 76.69. You've already got this calls trade. You may have bought this puts trade. First off, for the puts trade, it breaks above that zero line. What do you need to do? Stop out. But see, before you would even have to stop out of that, when it would break the high close point, couldn't I have taken another set of Fibonacci's and said, well, there was an up move to there and a low move to there. I'm going to take a trade for the 81.28. That way, if I have to stop out of my puts, I've now got two calls trades, and I'll make a little bit while that one puts position is going down. Why? Well, you know, just like here on this double top there. Not necessarily a reason to stop out of puts because it did go lower afterwards. Here I would have stopped out. There'd have been a loser after two winners. Okay, so you'd have had two winners, one loser. And on this calls trade, if I hit my target and I had calls, would I have to say that's a winner or loser? Even if it only moved a couple bucks from where I would have bought. You know, from 77 bucks to 81 basically. There'd be a win, right? And then obviously right here, we would have had to say that's a win because it hit our target. But through this process too, by the time we get any resemblance of it actually pulling back, like here, we had already seen it retest our old target as support and move up. That's when we would have had to say, you know what, I need to look at this trade now because I already sold my other ones. But let me back this up, because we would actually still been at this point here. And we would want to go back through. Here was the last visible down move, right? This was just a red candle. This was just a red candle. These three red candles was a visible down move, correct? Now, if we're looking here, and by the time we get two red candles, we're like, wow, do we really want to trade this from $90.91 to $89.67? Do you really want to trade that? You might be more interested in that other visible down move with that high, this low, this high. But being that tight, it's pretty easy to say, hey, I need to get below that 89.67 before I can look at 83.39. Wow. What did it just do there? It touched it and moved up from it, didn't it? Now let's think about something. I had used simply this down move. So I used this point here, and this high. If I'm thinking that's showing some accuracy, I want to combine as many of those points as possible. So I'd have to shift it over to the first point being that low, the high, and the low. You know, now you probably can't even see the chart. 111.65. I didn't even want to take this short. I'm going to leave it on there for a second. But as I go here, well, that short is null and void now, right? Oops, I deleted the wrong set. Hold on a second. The reason that short would have been null and void, it broke the zero line. But then when I get here, I mean, come on, what am I looking at? What do you see here? There's a 100% line. You might want to say, hey, it hit the targets. I mean, you wouldn't even be waiting for the pullback from it. You know, right here, that target was 97.12, the high. Well, I guess it didn't hit it. It was 2 cents shy of it. But if I was a little afraid that it looked like it could hit, wouldn't I want to mark that last down move first and see if it failed this 91.70? I know it's kind of getting a little jumbled. There's a 91.70. Oh, and then look what it did. It failed my zero line. Again, making me not want to get in the short because so far it's done nothing more than replicate these tiny moves on the chart, right? Now here it definitely broke 97.12. So what would we say about a trade for that target? Probably have to say you hit it, right? So regardless of where it went from there, you'd have that other opportunity. And now notice I'm not marking every red and green candle. I'm actually waiting until it actually looks like it might be more than one red candle. As time goes on, well, you know what? This looks again like two red candles. Let me see where it could go down to. And here you see I pierced it, but I'm waiting to see if it can fail it. And then again, starts moving up. Well, what does that look like it did? Does it look like it made the pullback consistent with the last two pullbacks? Isn't that what it looks like? So if I used this high, this low, this high, this low, is there another target to trade for? Now, as you go through this, you're going to say, wow, that hit the target, didn't it? Wouldn't you sell this one here and have to put another one in the win column? Now this, even though it's not 2 red candles, that's a pretty big down candle, isn't it? So again, staying consistent with what we've talked about, well, look what it did. It still didn't even fail the point to be a normal pullback from what it's done 1, 2, 3 times since the first higher low, right? And as the time goes on, wow, that's looking like it bounced off my target. I'm probably going to be looking at this low, high, low, and see if I can weasel in and delete that one to see how we do in relation to, now you could say here that failed my 0 line. And if you're really disciplined, you'd have maybe be stopped out of that one for a loss. You'll hear me say a lot, I'll wait for the close of the candle or I'll sell it on the next up move. But we'll chalk that up as a loss while still being able to be in this. And you see how when this high is made, all of a sudden, you've got a completely different view of what a visible up or down move is. You see, this time, this time, this time are all the same. This time was different. Just looking at it visibly, I'd have to look here to here to here, which, if I put this up, okay, that gives a target 125.87. I might even need to look here because at this low, I had a higher low, which means something's changing, and up to this high and this low, a consolidation here. But I might even want to look at the last point in which something changed for this here. Now, in this particular case, I would probably have to say that by the time you were buying this, you'd say, well, that 105.64, it's not worth trading for. But how I would use that is to say, you know what? If it breaks that 105.64, that's where I need to buy the 125.87 target and the 128.41 target. Okay, so I'm going to delete this one because I'm saying I don't think that would be a reasonable trade, even if you could say later, well, look, it kept going up, because you've got this trade too, and you don't want to bury yourself on the one side when it does that. So through time here, you would have taken these 2 other trades because it broke that 105.64. But what would you have to say about this one? Target hit? So we could delete that. And just because target hit, it's not showing us any reason to try to call the high, right? And we go and do our thing. Well, now, son of a gun, it doesn't look like it's hitting target, and we've got 2 call trades. If we're heavy on that call side, we need to have looked at one of 2 things as soon as this thing started looking like it's not going up anymore. We need to first mark this area to say if it breaks below there, we need to take a puts trade. And then the last visible down move would be clear back here to say, well, shoot, that's not giving us a lot of room. So by the time we even get into this, we're having to look at, wow, this could kind of hose us here. Or we take a random guess at another time to buy, and I will tell you, if I ever have 2 calls positions in a situation like this, I'm going to be quick to buy a puts play, even when I might look back later and wish I hadn't have. But I would be quick to buy a puts play, but you do see a little bit of a reversal pattern again being made here off these 2 Fibonacci points, right? Now, at this point, would you say maybe again that I've got a clear up and down move? Well,
So simply mark those out would be okay. And allow me to take a third trade here, this 129.20, and continue out along the way. Now, here's a target hit, right? And right there's two targets hit. Oops, hit the wrong button. I hit the right button on the wrong thing. You know, and there's two targets hit. And as we hit all those targets, then we do this, and then we do this. Well, wouldn't we start to think about another down move being made? The first down move we have to go off of now tells us from here, right there around 120 might be pretty probable. And I don't think it'd be wrong in this case to take that trade. Now the time might come where it's like, wow, I just closed with a higher close. I might have another up move I got to trade for. And now looking up there, and I remember going into that where a lot of people, and I think I even said at that point, hey, if this keeps going, 150 would be possible. Here, my zero line for that puts trade is no longer valid, is it? And I'd have to chalk one up to the loss column. And then sadly, if you really followed it, you'd find that everything to the long side didn't work either. But on your failure here, if you'd have stuck with your chart, you'd have had a couple other trades to be looking at. First off, if it failed 119.42, the first point you'd have been looking at, I'm going to have to back up the chart to what we would have been looking for after that point. Let's see, we would have had one that would have been pretty much right in line with the 119.42, actually a little higher than it. And then all of a sudden, we've got to go back to a point we hadn't even used to find that, wow, even that doesn't go lower. And then you're going to be using this one clear up here. And then you're going to say, well, that one didn't hit either. Let me zoom this back in because that's just a point you would have had to have on there because you didn't have anything else to go by. Let me go back to that point here. You know, first off, when it hit this line, you would have needed to look at, if that's what you were looking at for the pullback and it made the positive move from, you would have needed to look at this. So let me delete that one. And do you see what this did right here? That's 132.13. And what did it do from there? It hit your target, right? And why at that point would you have not been having higher targets? Think about it. Every time that I came up with higher targets, we were making higher lows, right? Look at this low, because we're marking with fib extensions, we're marking absolute price, right? It's not like Fibonacci retracements where we marked a closing price. We're marking an absolute price. This low here, visible up move to here, visible down move to here, that's a lower low. It produced a high target that was a lower high. And when that one hits and pulls back from it, aren't I again going to have to make targets like this? targets like, well, that one's the one that hit that produced that up move. But when you get into this point, this is where it gets goofy and kooky. When you're trading to a target, you've got two choices. Sell exactly at the target and suck it up no matter what it does, or do what at your target. Make your target your stop, right? So at any time it would break back above your target, you would stop. Now me, I'm not going to lie. I'm one that says sell at your target and hit it more times than not. And even if it does exceed it a little bit, you usually kind of reverse a little bit after that. So you're just better off taking that shorter term, not shorter term trade, but you get out quicker selling at your target, which means sometimes I'll miss that. Now, the bad part about this is, according to my targets, when it failed the one to buy this one, did it hit this target? Did it hit this target? No, it did not hit that target. Now, granted, I will say that on August 24th, things gapped down so hard, 1,000-point down gap on the Dow. You guys remember I put out something that said I'm selling all my puts? I literally said I was putting a 15-cent trailing stop on all my puts. Everything. I went from like 85 to 90% of my positions being in puts, 85 to 90% of my portfolio, the total money being in puts, to 0 positions. I was all cash. I didn't sell all the calls till like later that day, but it was because the premiums were inflated so high. I was like, you know what? I didn't even lose that much on my calls. I know Moss was talking about some stuff like that, and I'm pretty sure Leonard might have noticed that too. You had that big down drop, but the premium inflations were so crazy, the calls were nowhere as far down as you would have thought, considering how far up the puts had moved. And I literally, on August 24th, went 100% cash. Did it hit my target? No, so I'm not going to say that. But do you see where we just went through the last like couple years of up moves on Apple? Or that couple year of one up move? Now, if you happen to see this big fall, and I'm not even saying waiting for the whole week. Hell, if it dropped down to 92 and by the time it's back over 100, you might start thinking, where's my next visible up move? Well, real simple. Use that first one to gauge not a trade to get in, but if it breaks it, to enter. Well, that would have been clear up at like 105, but to enter a trade for a 121.91 target. And in that case, I'll be the first one to say that you'd have kind of been screwed the other day because you didn't quite hit it, nor did you quite hit this one. But if you're going to follow those same guidelines for the conversation we're having, have you had to stop out of either of those yet? Would you have had to stop out of either of those yet? And I'm pretty sure we could say no. Now, the question was asked, well, what expirations do you choose for that? If you guys remember, like these times when we were going up here and we had like the 2 down candles, and up here it actually exactly replicated the move. And even to this first green candle drop, it replicated the same drop that was seen there, and this down here. If you trade the amount of time needed for that prior move and add 2 weeks to it, more times than not, you'll be okay. Now let's really think about that. If I was trading to that 88.93 target and would have bought that, say, the last week of July, would I have been trading the August monthlies or even the September monthlies for a set that was based on a drop that went from September 17th down to a low point on April 15th? So that's October, November, December, January, February, March, April. That's 7 months. I'd have probably been trading that 8 months out, in which case I would actually still have time, wouldn't I? Because buying that here, going 8 months, or 7 months plus 2 weeks, so 8 months, because I like to trade the monthlies for my swings, so it would have been 7.5 to 8 months. I might have seen that position go up a whole lot and not be up as much now, but wouldn't I still have plenty of time? I would have till, let's see, August, the end of August, September, October, November, December, January, February, March. While those ones that could have been traded for the little blips down, you would have only been trading a month out, and 2 weeks into the trade, you'd have been out. The up moves, well, you're looking at 6 weeks up. So over here, you'd be trading 2 months out. 1, 2, 3, 4, 5, 6 weeks up. You're good over here. 1, 2, 3, 4, 5, 6 weeks. You hit the high. So you're looking to replicate the move not just by time or by price, but also by time. Is there a time where that's going to hurt you? Yeah, it's inevitable. Well, it's inevitable it'll consolidate once, like right over here, and might screw you out a little bit. But if you're trying to approach something with consistency in a trading system, you can't look at that one time. You have to look at all the other times, don't you? Now, the one thing I personally would not ever recommend anybody do is mix and match your trading systems. I don't think that's healthy. When people say, oh, well, you know, it pulled back from a 50% Fibonacci retracement, but it hit my channel line, and I also got a moving average over here. That's nitpicking trades so much that if you're waiting for that perfect storm or fail-safe trade, it's never going to happen. And then by the time you finally convince yourself, you've actually convinced yourself not by the system that you've got on your chart, but by your emotions, in which case you're basically clawing at desperation. Not exactly a good place to be. Do I think it's okay to make separate trades on the same stock using separate trading systems? Oh, you bet your butt. But that requires a little bit of degree of difficulty that most people aren't willing to realize the ease of. You know, I've got this thing on my desk. It's called a notebook, and right beside it's an ink pen. And what you do on those pieces of notebook paper is you take the ink pen and you write on it. You make notes to yourself. So if I was making notes to myself and going back to that Fibonacci retracement chart we talked about, saying, you know what, if it goes above 116.01, I might be looking at a trade on 120 calls because I got to assume my resistance won't be broken. Or I could wait for it to break that 120 level and really be trading clear back up to these highs again. Or if it fails the 114.73, I'm looking at a puts play on a dead cat bounce down to my zero line at 105.76. So, you know, depending on how far out I want to trade, I might actually take 105 puts, even though they might not go in the money by there, or I might take 110 puts. We'll see. but I wouldn't actually allow this trade to have any bearing on these trades. And what do I mean by that? Well, if you think about those times where I was outlining those Fibonacci retrace or the Fibonacci extensions, saying we could be in a call straight here, and now there's two other call straights here. I didn't say sell all of those call straights just because one of the targets was hit, did I? It was sell the one that hits the target for the target that you had when you bought it, which actually does what? You know, if it goes the other way, yeah, you could look at it and say that could screw me on my other ones. And that's what usually people do. If I say I'm selling this one but keeping this one, why wouldn't we sell them both? If you're selling that one, don't you think it'll go down? You know, I can understand that misconception. But in reality, if you're making those multiple trades, I'm like, hey, I had like 5-6 trades and that one hit its target. I want to reduce my risk. If it does turn around, I don't want to still have the one that hit what I thought it would. At least give me the money for the one I was right on. Even if that means I'm going to be wrong on 4 of them, at least give me the money for the one I was right on. So even though it's the same stock, I wouldn't make my trades on the same trading system. And by that, what I would mean right here is assuming that because Apple shot up to like 118 after the earnings was reported, but at the same time came back down and then's trading, you know, about 75 cents higher than what it closed at today, I would mark just like I marked all those other times. The first move to say, hey, if it comes down to 109.65 and makes an up move, I want to buy calls. But if it fails that, hell, I might want to go high, low, high, and buy puts. But I got to wait to see what it does at 109.65, even though that means it could have to drop $5. But does that, oops, hold on a second, let me, come on. Okay, I failed at that, hold on a second. But with that trade of wanting to wait for it to fail 109.65 or at least get to it and bounce, have any bearing on me wanting to trade a Fibonacci retracement trade that failed 114.73? My answer would be no. I would still make that Fibonacci retracement trade, but the difference is I'd have one trade, not two trades. Would I use that 109.65 potential bounce point to exit this trade? No. I would use my support and resistance. Why would I do that? Well, people are going to have winning trades, they're going to have losing trades. There's also going to be times where you're using a winning system, but you fail at it. Is that the system's fault or your fault? You know, back in March and April, I had a winning system that I failed at. Kicked my butt on GS. Some of you guys remember that. The system didn't fail. I failed to use the system properly. But if the system proves accurate and consistent, but yet there's a completely different system that also proves accurate and consistent, one would automatically think that if I combine the two, I've now got like the perfect system. And that's the real problem with trading. Anything you think, you will see the opposite of. I hate to say that, but I've seen it too many times. I've seen those perfect storm things. Well, as a matter of fact, in August, or September, I saw that. I actually was afraid of it, but I said, you know, I had to trade it.
And I got in a bunch of trades saying it's like a perfect storm thing, all these things lining up, and guess what? It went sideways the whole freaking month and screwed me. But it was that perfect storm of stuff I thought I had to do. And would I do it again? Yep. How could I say that with having some losses on that? Well, because the only reason I traded at that time is I had done it in the same instance type thing before, and it didn't screw me. And maybe times before that I either traded or studied, they didn't screw me. So one time did. So what? Now, if you look at this alone, just on these weekly charts of Apple, and I am going to say 100%, I think Apple is the ultimate Fibonacci chart. That's why anytime I teach a Fibonacci lesson, I use the Apple chart. I've done that for years now. Anytime I've talked or taught anything about Fibonacci, I use Apple. It's the ultimate Fibonacci chart. The ironic thing about Apple is it's also the ultimate swing point chart. It's also the ultimate moving average chart. And I'd probably venture to say, if not the ultimate, a pretty darn good channel trading chart as well. Apple is overall a chart that can give you many, many trades, but if you combine those systems, you get shot in the foot. If you trade them all independently, you'll find that, wow, I bought this trade not waiting for it to cross 17.5 points before I went long to one of these 19 targets, but I failed to realize it hit target 1 and pulled back. I was looking at target 19, and so I screwed myself on a big trade, but saying, hey, it went up through 17 buy points and hit 11 sell points, and I made money on the majority of the trades I made. So when we look at that type of thing, we also have to look at, what we might be able to trade individually. And let's think of that. I mean, walking through that Fibonacci extension walkthrough, I clearly talked about like 4 trades at one time, right? Talking about the Fibonacci retracement side, we're looking at 2 or 3 different trades. Well, that could be 6 or 7 trades at one time that are all completely different trades, but could be all worth your while. The average Joe can have trouble or struggle going past 5 or 10 trades. Therefore, it could be pretty possible for you to learn to master one chart before you half-ass 2. Now, you'll say, well, you say that, and then I see you trading a whole bunch of stocks. Well, yes, I trade a whole bunch of stocks. But the one thing I try to make clear is I didn't start out trading a whole, well, actually, that's a lie. I started out trading a whole bunch of stocks. Then I realized that was stupid, and I started trading 1 or 2 stocks. And then over time, I've built that up personally to many stocks. But the point is you might be at the point where you've just kind of realizing for you trading many stocks is stupid. So where you might want to trade 1 or 2 stocks and get to know those stocks and study those stocks and then start trading more stocks. And that's okay. That's what this service is about. It's not about alerts and stuff like that. It's about education. And that's the big thing to focus on. What can I learn so that I can take control of my money? And sometimes it is better to focus on little instead of overwhelm yourself with a lot. Now, with that being said, I'm going to go back over to this chart.
I'm going to detach one more. Went a little longer than I had anticipated, going through